Welcome again, everyone. And today I would like to really present on the outlook for the Singapore equity market and share more of our thoughts on the market for 2022, particularly sharing a bit more about the Nikko Singapore Dividend Equity Fund. For some of you who are familiar with us and because you've heard us speak before, thank you for your support and welcome back. For the others who might be here for the first time, to you, it's good to see you, and we hope this presentation will be useful to help you to make some of the decisions for you for 2022. Let me first begin with a quick introduction for Nikko Asset Management, followed by the outlook of the Singapore equity market. A quick summary: our corporate profile speaks of our DNA. We are one of Asia's largest asset manager, with a strong passion and focus on Asian investments. We believe in providing our clients with progressive solutions and focusing on performance, as well as a citizen committed to ESG is really one of our attributes. We also happen to be one of the longest and oldest managers for the Singapore equity product by virtue of our acquisition of DBS Asset Management more than 10 years ago. So in total, we have about more than 280 billion in asset management today. The title of our presentation is really Singapore Equities on Firmer Footing. Next slide, please. Thank you. Now, when we look at 2022, we think the theme of recovery is really going to continue to support the Singapore equity market in the year ahead. We see a firmer growth path for Singapore, where we expect the broadening of growth within Singapore's key economic engine in 2022. Particularly, we do see in 2022, there'll be a pickup in the service sector due to the economic reopening. Let's look at the gradual relaxation of the mobility the restrictions that we have seen since COVID-19 has started to abate. We think that is actually going to continue to recover. And we are also sanguine on the Omicron impact because of its lower virulence, as well as Singapore's high vaccination rates that will help counter the impact. In summary, we think the mobility indexes will continue to recover to pave the way for the economy to do better in the year ahead. Next slide. Now, we also believe that growth has been really a very solid growth in Singapore. Preliminary estimates have put Singapore's GDP rising by 7.2% in 2021. This has actually brought Singapore above its pre-pandemic levels in 2019. And what is also impressive is that it is the only Singapore ASEAN economy to do so compared to the rest of the region. So this is really coming down to the demography of the market, which I will share a bit more later. Next slide, please. When you look at the Singapore economy, you see that growth is actually broadening out. Manufacturing and exports related sectors, no doubt, were the stars of 2021 in terms of contribution to the economy. That is actually moderating. We think it still remains resilient for the year ahead because we believe global demand will be healthy. But what is interesting is you look at the other part of the economy, which is the service sector. We believe that that could be actually the source of strength on incremental growth for Singapore as we enter into 2022. Sectors such as wholesale trade, transport, and even logistic services, we believe would actually surprise positively as the country emerges from the endemic COVID-19. Next slide. Transport services is actually a very important part of Singapore. Singaporeans like to travel. But I think when you look at the breakdown of the Singapore's economy, you actually see that the transport sector is actually represented a lot by the services route in Singapore. And you can see that tourist arrivals is actually starting to pick up. Now, VTLs, which is something I believe in most Malaysians will actually know that is actually an important part of this recovery. And today, VTLs have actually gone above 50% based on the actual arrangement from Singapore and other countries. So we think 2022 will start to see a continued recovery in international travel. Next slide. We also thought it's a good time to remind our investors why Singapore is really a very solid investment case. We think Singapore continues to have very strong political stability. It is also very competitive in its talent pool and remains very strongly engaged in global trade and international business. Particularly through COVID-19, we have actually seen Singapore accelerate its digital transformation during this time. And we think this will actually be one of the key attributes going into this recovery. Next slide. When you think about the FDI proposition in Singapore, you also see that despite COVID-19 and the impact that it's brought onto the economy, we have actually seen FDI or foreign direct investment continue to remain robust. And this is really coming from various sectors. But what is interesting is that particularly in the new economy sector, companies such as Tencent, ByteDance, Zoom, and Rakuten have actually stepped up the investment into Singapore. And many of these companies have also moved their regional hubs to Singapore. That says a lot of things. That says that they believe that this continued recovery in digital will actually be hubbing a lot in Singapore. So we think that's going to be playing into a very strong FDI, even post when we see the economy come out of COVID-19. So we think that's going to be an area that we want to emphasize on. Next slide. The diversity of Singapore's economy remains a very strong attribute as well. We think that when you look across different sectors, from traditional manufacturing, construction services, property, to even newer parts of the economy, such as information, communications, financial services, and logistics, Singapore is a well-diversified economy. And that's actually very important when you look at investments that you want to have a resilient and diversified proposition. Now, next slide, please. One of the strong attributes of Singapore is really, as I mentioned, its growth in the digital economy. Now, Singapore may not have a large population to really drive e-commerce, but in many ways, Singapore is the channel that many of these investments are going through. So we actually believe that the real strong potential in ASEAN, and that was shared by some of our previous speakers, is going to be continuing to be a very sharp attribute of the attraction of growth into the region. And Singapore will be able to tap into that growth through its digital economy and ride on this growth, gross merchandising value that we see to be tripling over the next 5 years. And we think that's going to be very supportive for investments into Singapore as well. Next slide. When we put together then the outlook for earnings, the economy, and valuations, the first chart I would like to share is that the economy is effectively still on the road to recovery. We have seen 2021 represent kind of a V-shaped recovery where the economy has gone above pre-pandemic levels. We believe that 2022 will continue to offer good growth on the tailwinds of the economic reopening, particularly on normalization of supply chains and the service sector. So we think that growth will still be exciting in Singapore in 2022. Next slide on earnings. This is really interesting because you can actually see that earnings have actually tracked the same recovery in the economy. Very strong growth in 2021. And we believe that double-digit growth is still possible in the next coming years. And earnings growth with double-digit growth is respectable, especially in a time as we see today that growth is moderating. We also expect that this time we will also see consensus estimates in Singapore being resilient during this recovery. Next slide. When we look at the broader implications for sector selection, you can find that actually 2022 will be looking slightly different from 2021. Singapore banks is a large part of the market and a large driver of overall EPS growth. And you can see that in 2021, a large part of returns from EPS growth has come from the banks. 2022 will be actually quite different. 2022, you'll start to see a greater spread and diversification of growth across more sectors. Sectors such as transportation and communication services, as well as other parts of the market. And that is going to be very good for what we call stock pickers, investors that will be able to invest in various parts of the broader economy. So we think this is going to be a very interesting attribute for 2022 as we see growth broaden out for the economy. Next slide on valuations. Oh, sorry, this is another slide that I thought is really interesting. We think stock picking will be very exciting in 2022, and active managers such as ourselves believe that the best value we can offer for our investors is to really stock pick and to pick companies and sectors that are well positioned in this time of change or economic recovery. So we start to see that this year there'll be a greater broadening out of growth across sectors. Banks will be still very much a big part of that growth, but we think that across many other sectors, growth will actually be also very exciting. If you look at commodities, you look at healthcare, you look at even capital goods, there would be actually a large variety of earnings recovery plays that we would be very keen to participate on. Next slide. Valuations is something that is always interesting for Singapore. Singapore is a value market. And you can see whenever we compare regional valuations or global valuations, Singapore always looks attractive on a PE and price to book ratio. The reason is obviously Singapore returns on an ROE basis are not very high, but I believe that that is also a very interesting characteristic for Singapore. So we believe that valuations is actually, in fact, today a very defensive proposition. As you know, today markets are very concerned about growth, especially growth from the new economy. I think Singapore is a little bit more older economy where a large number of the stocks and sectors actually help to anchor valuations, which is close to book value, which I actually think is actually very defensive in today's environment. So that is a positive going forward. Next slide. And dividend yield, last but not least, is actually one of the most attractive propositions for Singapore. You can see on the right chart that Singapore and Malaysia actually offers very, very attractive yields on an absolute basis, and particularly on a relative basis. And even though the market has done well in the past 12 months, dividend yields in Singapore is still actually very healthy at close to 4%. And we think that when you go beneath the hood towards companies, there are also a lot of what we call dividend anchors and companies like Dividend Growers that offer you very attractive dividends, which makes Singapore a very attractive proposition. So in summary, the next slide, we think that Singapore is on a very strong footing for growth into 2022. We think Omicron is unlikely to derail the recovery, and 2022 looks to be really what we call a restoration and continued recovery of the economy and markets, especially for the service sector, where we think international travel could come back a lot stronger than than the market expects. And we believe that the earnings recovery will ride on that. And we also expect valuations and the dividend proposition for Singapore to be also added advantages for the market when we compare investments across the region. Now, let's move to portfolio strategy, which I'd like to share now. Where are we positioning? What are we thinking about as we move into 2022? Now, this is, again, the same chart that we shared earlier, but I'd like to dwell a little bit deeper into what we call sector selection. Now, we believe that 2022 will actually see a greater bifurcation, a greater spread of growth across different sectors. And we believe that growth actually, even though growth stocks are seen to be suffering the most from the current flow in the markets, is actually very important in today's scenario. We think that companies and sectors that can give you a sustainable growth profile at a reasonable price and valuation could actually do very well. And with a stronger focus on growth, we believe companies particularly and sectors that are growing in 2022 much faster than the market will actually outperform. It's quite intuitive, right? You want to buy faster growing companies even as the economy is moderating. So we want to look for companies and sectors that have good growth buffers, that have good quality, and we believe that industrials, consumer discretionary, which includes some of these retail sectors, as well as technology, pockets of technology will still give you good growth in earnings in this time. Now, next slide is something that I believe is very unique to Singapore is also a restructuring economy. And we have always coined this term, the new Singapore, to really represent the fastest parts of Singapore in terms of the companies and the sectors that is actually growing and that is actually innovating. And this innovation is actually part of Singapore's DNA. You can see that many years ago, Singapore was a very industrialized nation. And then we actually saw the rise of modern services. Today, we are seeing a very interesting period of innovation. And sectors such as technology, data centers, healthcare, tourism, and even medical technology, medtech, is actually going to be areas that we think would actually be very good investment propositions. And we like certain structural growth opportunities in that space. When we go to the next slide, this is a way where we like to perhaps better articulate what we consider in terms of companies that we want to invest in. This is an illustration. We believe companies that are plugged into the innovation, the ecosystems, and the service recovery will actually offer you good investment opportunities. So we know tourism, food solutions, data, technology, renewable energy, and logistics are actually areas of growth in Singapore. And we want to find investment companies that can best proxy and represent that growth. And this is an example of how we want to overweight companies that actually play very strongly into these themes. And the next slide, please. Restructuring is actually also very interesting in terms of M&A corporate activity. Now, you can see that in the past 1 year, restructuring and corporate activity has actually accelerated in Singapore. And this is not coincidental. It's because really companies are trying to innovate and trying to right-size their balance sheet even as they go through the COVID-19 crisis is actually very positive for companies to actually improve their returns. Now, if you look at just some examples in restructuring, a company such as Wilmar has chose to actually unlock value for its investors by listing its overseas operations. Sembcorp, the Jardine Group, the CapitaLand Group has been very busy into really right-sizing their businesses, either through demergers or through spin-offs to really improve returns for investors. And I think that's a good sign that Singapore corporates are actually trying to focus on sustainable growth going forward. Now, we think there's going to be more to come. And I'd like to share maybe a few areas that we're looking at that we think corporate restructuring could be interesting. I won't cover companies, but I'll just tell you really the broad themes that we like. We believe that restructuring is important to improve sustainable returns. And one of the most exciting periods of change today is actually in energy transition, renewables. We think that's going to be a very important area of growth and transformation for Singapore. And we see this most particular in the industrial sectors, notably utility, infrastructure, and these are areas of investments that we think will be very attractive. Companies in this transition are really moving towards demonstrating ways to diversify towards decarbonization, green financing, and recycling capital for growth. That's really where we are, I would say, putting our emphasis on investments in restructuring for 2022. Next slide. So now let's move on to the next discussion on the Singapore Dividend Equity Fund. Now, this is a flagship fund for our Singapore equity team, and we believe that this is really one of the best ways we can approach investments via looking at dividend returns. The next slide. If you look at our very simple approach, we look at a balanced approach between capital appreciation and dividend yield income. Very simple dual way of looking at how we can enhance returns for our investors. Next slide. When we go to the Singapore proposition that I shared in the past 15 minutes, you can probably get the conviction that Singapore is really a very good defensive proposition, especially in uncertain times. It has a resilient economy, a stable currency, and most importantly, a very attractive dividend yield of about 4%. And when you drill down to that 4%, it's really backed by good cash flow, strong dividend payouts, and very defensive balance sheets of the corporates which make up the Singapore universe of the market. And in 2022, we think that dividends will continue to feature well in driving these returns. Now, we want to place a convictive strategy on two parts of the market, what we call the dividend anchors, as well as the dividend growers. Now, let me share very quickly what these terms are to us, and that will perhaps give you a better understanding of how one can actually invest really through looking at dividends. Dividend anchors are what we consider to be very high and sustainable dividend yield stocks. They basically form the bulk of the portfolio in terms of anchoring returns. We believe Singapore's unique demography in the market will offer really a very high portion of companies that are high dividend paying. For example, the banks in Singapore are very high dividend payers, and they can offer a very good dividend yield for the portfolio, something like 4%. Now, this is encouraging to know that this dividend yield at this time will help anchor the market, especially when the market is worried about growth and interest rates. Now, the second part of the portfolio will really come from dividend growers. Now, these are the real growth uplifts that we are looking for. They are quality stocks. They are also dividend payers, but they may not pay as high as some of the dividend anchors. And what these dividend growers do is they really represent high dividend growing companies. And dividend yields could be rising from 1 to 3% to what we think to be as much as 5 to 6% as they run through their overall growth cycle. And dividend growth is very important. As I shared today, we are actually going to see a lot more focus on growth because, frankly, growth today is looking a lot scarcer, a lot more difficult to find growth. And if companies can give you good dividend growth at a time where growth is moderating, I think there's a lot of potential for these companies to be re-rated to higher valuations. So that's what we're looking at. In fact, that's an area that we believe will do very well in today's environment. So in summary, I believe that dividend investments are really relevant in a time like this. And we think that against the backdrop of growth deceleration in 2022, capital preservation, the importance of returns will be important to drive returns. The next few slides really highlight the performance of the different share classes, currency share classes, the ones in Malaysia, as well as Singapore and in the US dollar terms. And you can see that one very thing strikes out, which is actually stability and really, a decent returns for our investments. So with that, I thought I could just, end the presentation, and I'm happy to take all the questions that you have on Singapore, on dividend investing, and I hope that that would really be interesting for you. Over to you, Alicia.
All right, so moving on, we have our Q&A session now. So the very first question here, for the gross merchandise value for digital sectors in 2025 estimated, Singapore percentage is lower as compared to the Indonesia, and this client will appreciate your comments why Singapore when the pie is lower.
Oh, it's actually, thank you for the question. It's actually true that, Indonesia is the lion's share or the largest part of any ASEAN growth proposition in the internet space. E-commerce is currently 50 billion in terms of value, in terms of the value in Indonesia. And we think Indonesia is going to grow to 200 billion in the next 5 years. I mean, I look at ASEAN as well, and I think that's really a very, very exciting proposition. Singapore is more a conduit, I would say, a representation of a lot more through the financial side of how financing will be done for the growth in the internet sector. So a large part of the operational part of the growth in internet will come from e-commerce in Indonesia, but Singapore really plays a bigger role in trying to harness how that transactional part of that GMV is monetized. So it may not be as fast in terms of growth, simply because it's really more, as I say, an intermediary of trade and intermediary of that GDV. But I think that's also complemented by other areas, which is really services. And I think a lot of the services that Singapore does on the internet space, on the new economy space, is a bit different. It's a lot more to do with headquarter and areas of growth. And I think that's actually going to be also exciting. So it's different, but I would say that also the growth is actually quite respectable.
Right, thank you so much for the information. And then moving on, the second questions here. The graph that you showed just now, so meaning that the gaming and transportation have better growth prospect in the 2022?
Gaming, maybe when you think gaming, I presume you're talking about really the consumer discretionary, and particularly the main stock in Singapore is really Genting Singapore. I believe that we are more positive on the transportation side of that service economy. We think that a lot of the mobility restrictions have really capped a lot of the growth that we see. And we think 2022 will really represent a greater normalization of some of that trade, as well as some of the travel and tourism side of things. So I think Singapore will benefit from that because clearly there'll be a recovery. But we believe that actually there are a lot more structural advantages in some of the transport arena. So the companies that we like actually are more well positioned because they have actually been putting in place also strategies to improve their returns in that regard. So for example, some of the travel areas that we see, there are many companies that are also focusing on improving catering businesses. Like for example, SATS. SATS is actually an example of a company that is really growing, not just riding on international travel because they supply to Singapore Airlines on food, but they are also growing in the area of being a food merchandiser and a food company that actually focuses on quality food into the region. And I think that's really one of the attributes that actually help support that recovery.
Okay, so another one, could you share which sectors will fall into the dividend anchors and providers category in Singapore equities?
Actually, a very easy way to kind of do the segregation is when you look at Singapore's overall dividend yield is about 4%. So when you think about anchors and you think about the real dividend growers, you can look at it as a bit of that clearing point. So companies that have very strong dividend anchors, for example, will represent some of the banks. They are paying dividends that are well in excess of 4%. At this time, the price have done well, but I think that's something that we think is still going to be sustainable. And also a large number of the real estate investment trust, as well as the business trust in Singapore, is actually also yielding very good dividend yields. So this will be part of that dividend anchor portfolio. Now, dividend growers is a little bit different. We look for dividends. So we are very clear that dividends is a very core part of this portfolio. So if a company is, let's say, a new technology company, and they pay zero dividend, and they tell you that they're not going to pay you dividends for the next few years, even though they're growing very fast, we will not invest it for the company like the Singapore Dividend Fund, because we know that dividends is going to be a very important part of returns. Unless the company suggests that they're going to increase dividends, we're going to avoid it. But there are many companies, Alicia, that are really paying dividend maybe of about 1 to 2%. And we can see that the growth rates of these companies are going to be on a multi-year cycle of double-digit growth. So this dividend will actually grow by 20, 30% in the next few years. So that dividend yield, it becomes something like a 3 to 4% dividend yield as we kind of push out that growth profile. Those are really, really very attractive. And that's what we really want to invest in Singapore.
Yeah, great. Yeah, and another technical questions. Just a moment. Okay, with the increasing interest rate foreseeable in the near term, will the dividend yield suffer?
Oh, I think that's a fantastic question. And I believe that a question that we get very much. Now, the backdrop of rising yields is going to happen. Like it or not, I mean, I think there's no sugarcoating around this. Interest rate will rise. It will put pressure on what we consider to be high duration or high yielding stocks, because the comparative here is that interest rates are moving higher. So you need to compensate for even better growth. That actually underlies the importance of dividend growth, as I shared earlier. Now, we think that today, even though interest rates start to rise, the overall spread of dividend yields versus bond yields is still attractive. So it's not to the point where dividend yields become less attractive. So I think number one, I think that's going to be a positive for dividends, growers and anchors, even in this environment. But we do agree that a larger part of returns or alpha will come a lot more from dividend growers. So imagine this, if a company is actually facing a macro slowdown, higher interest rates, would you pay a lot more for growth certainty in this time at this point in the market? The answer is yes, because you want to really, in fact, sell stocks that are unable to defend growth to buy companies that can defend growth in this rising yield. So dividend growth is number one, giving you that ability to secure income and grow the income. I believe that is going to be really a added proposition. So it is not to say that it won't be impacted by rising interest rates, but I believe that there's opportunity for these companies to be even re-rated and improve because of the kind of returns it provides.
And then also on top of that, adding on to it, will the recent surge in the Omicron affect your Singapore dividend fund?
Oh yeah, I believe that the Omicron is unfortunate. It's something that, you know, is causing a lot of rising in cases, but we are quite comforted that it is not as virulent as the previous cases of Delta and even the first few waves of COVID-19. And I think that gives us some comfort that that the economy reopening, while may not be a full reopening, is actually still improving on the perspective of change. Now, I think it's important to know what the market is pricing in and what the market is actually seeing. So I believe that the market is not really fully factoring the potential recovery of the economy from Omicron. So while that will actually perhaps slow down the recovery, we think that it's still going to be in the right area of change. And that keeps us quite optimistic of investments in this broad thematic.
All right, just now you were mentioning transportation category, right? So does airlines include as one of it?
Yeah, I think airlines is an area that we look at. But when we look at really the importance of balance sheet, and especially for a dividend fund, I think one thing we want to anchor and to be assured of is really the sustainable of supportive dividends going forward. So I would say that, I mean, just from an illustration point of view, I think the business for airlines is a little bit more cyclical and is a lot more highly operationally levered as compared to perhaps other travel businesses that have actually a lot more cash flow. And I think that actually would be something that we are more comfortable with, you know, for the dividend fund.
All right, then moving on. Okay,
Sure.
How do you see the impact of UOB with its impending purchase of Citibank's operation in selected countries? Right. Positive or neutral?
Oh, okay. Unfortunately, I thank the question, but I'm not able to comment on direct stocks. But I would say this. I would say that, you know, again, when you look back to one of the things that we always watch for is positive fundamental change. And positive fundamental change means companies that are taking advantage of opportunities to really improve growth and restructure opportunities. Restructuring that I mentioned earlier, many companies illustrated. I think when you look at really M&A, as companies do that, I believe that actually adds to the growth potential of companies and also to the dividends that they can actually get from that. So I would just say that is actually in line with that kind of proposition. We like companies who do that.
Okay, so since looks like we have running out of time, so very last questions, right? Is ESG consideration part of the stock selection of the funds?
Oh, definitely. I think I would take it a step further, and I like the question. ESG has always been part of our philosophy in investing. When you look at really what we think is important in ESG, it's not so much how well you score, how well you do in terms of how many, how much carbon emissions you emit. It's more important for us that you are changing. You are actively improving your environmental, social, and governance impact. And that is actually very important in how we select stocks. we have companies that may not have very high ESG absolute scores, but is doing the most in terms of improving those scores. And that actually goes a lot, we believe, in driving future value of the company. So for example, the renewable opportunity I talked about in energy transition actually deals a lot with really change. So I would say, to answer that question, ESG change to us is actually as, if not more important than purely just being a very good corporate citizen in today's markets.
Okay, one last question, okay?
Sure.
On top of the Omicron variant just now, so what's the hospitalization due to the Omicron? And is Singapore health system be able to cope with the surge in the cases, although it's less virulent?
Okay, I believe that so far so good. We are very fortunate with a very good infrastructure and a government system that actually allows for hospitalization. So today, as we look at number of cases, I think the guidance from the ministry is that everything is actually still okay. But I would just also save it from the more corporate perspective that I think this Omicron case and even COVID before has given a lot more private healthcare companies the opportunity to support the government efforts. And you can see that in also some of the investments that we look at in the area of healthcare, that in this new time of, of test, trace, and vaccinate, we believe that companies that are also restructuring to basically partner with the government in providing, testing will actually be benefiting from this environment as well. So again, we are looking at it from a challenge, concern, and a risk perspective to turn it into an opportunity. And we think companies actually who look at that will actually do very well in this time.
Right. Thank you so much, Mr. Kenneth, for your insightful sharings. We hope that the audience will be able to grab some very important information over the Singapore equities. Right. Thank you so much, and we hope that we do see you soon on our next event.
My pleasure. Thank you, Alicia. Thank you, everyone.
Thank you so much.